In February 1995, one of the oldest and most respected financial institutions in the world collapsed. Not from a market crash, not from a recession, not from fraud by its executives or corruption in its boardroom. It collapsed because of one 28-year-old trader working alone in Singapore. His name was Nick Leeson, and what he did is the most studied case of financial destruction in history. Because everything about it should have been caught. Everything about it should have been stopped. And nothing was. Barings Bank was founded in 1762. It had financed the Louisiana Purchase. It had helped Britain recover from the Napoleonic Wars. It counted the Queen of England among its clients. For 233 years it had survived wars, depressions, panics, and crises that destroyed lesser institutions. It was not merely a bank. It was a British institution, a symbol of stability and longevity and quiet, unshakable competence. Nick Leeson joined Barings in 1989 at the age of 22. He was not from the establishment. He grew up in Watford, north of London, the son of a plasterer. He left school at 18. He did not have the family connections or Oxbridge degree that typically moved young men into the senior ranks of British finance. What he had was talent, an instinct for numbers and markets that impressed everyone who worked with him, energy, ambition, and an absolute certainty that he understood things other people did not. He was sent to Singapore in 1992 to run futures trading at Barings' newly established office there. He was 25 years old. He had never run an operation that size before. He would not run it for long before everything went wrong. Derivatives trading sounds complex, but the basic principle is simple. You are betting on which direction a market will move. If you are right, you profit. If you are wrong, you lose. The losses, unlike regular investing, can exceed what you put in, dramatically, because derivatives are leveraged. A small move in the wrong direction can translate into an enormous loss. Nick Leeson was trading futures on the Nikkei 225, the Japanese stock market index, from the Singapore International Monetary Exchange, known as SIMEX. His official job was arbitrage trading, finding tiny price differences between the Singapore Exchange and the Osaka Exchange and profiting from the gap. It was a low-risk strategy. It should have been straightforward. But in 1992, Leeson discovered a loophole that would define the next 3 years of his life. Barings had a structural problem. The person responsible for executing trades in Singapore and the person responsible for settling and recording those trades were supposed to be different. The rules of financial control require this separation. But in Leeson's Singapore office, he held both jobs. He both made the trades and controlled the back office that recorded them. Nobody at Barings' London headquarters noticed this. Or if they noticed, they did not act. This created an opportunity. Leeson opened a secret account, error account 88888. Officially, an account for recording minor clerical mistakes, the kind that inevitably happen in high-volume trading. In practice, from 1992 onwards, Leeson used account 8888 to hide his losses. Every bad trade went in there. Every mistake. Every bet that went wrong. The account 88888 was invisible to London, and London was not looking. By the end of 1994, Leeson's hidden losses in account 888888 had reached £200 million. He was in a position that every gambler in history has found themselves in, deep in debt, convinced the next bet would be the one that fixed everything. He needed the Japanese market to rise. He needed it to be stable. Instead, on January 17, 1995, a magnitude 6.9 earthquake struck Kobe, Japan. The Kobe earthquake killed over 6,000 people and caused $100 billion in damage. It was the worst natural disaster to hit Japan in decades. And it sent the Nikkei tumbling. The very direction Leeson needed the market to go was the opposite of where it went. Most traders at this point would have accepted the loss and closed their positions. That is the rational response, the mathematically correct response. Leeson did not do this. He did the opposite. He doubled down. He bought more Nikkei futures, massively, with increasing desperation. The theory was that the market was overreacting to the earthquake and would recover. It needed to recover. He needed it to recover. It did not recover. The Japanese market continued to fall throughout January. Leeson's losses grew daily. He was no longer trying to profit. He was trying to survive. And every day he tried to survive, the hole got deeper. He was now running one of the largest speculative positions in Nikkei futures in the world, from a relatively small office in Singapore, hidden from everyone at Barings who should have been watching. The account 88888 had become something no single bank should have been able to absorb. On February 23, 1995, Nick Leeson left a note on his desk. It said simply, "I'm sorry." Then he left Singapore with his wife. They flew to Kuala Lumpur, then to Kota Kinabalu in Borneo, then to Brunei, then Germany. He called himself Nick Leeson. He was arrested at Frankfurt Airport on March 2, 1995, on a warrant from Singapore. He had been on the run for 1 week. While he ran, the situation at Barings unravelled at extraordinary speed. When the scale of the losses became clear to management in London, the initial estimate was £300 million. Then it doubled. Then it doubled again. By the time the true numbers were calculated, Leeson had accumulated losses of £827 million, $1.4 billion, more than twice the entire capital of Barings Bank. The bank was insolvent. It had no mechanism to cover the losses. In the frantic days of late February, the Bank of England sought a buyer. Institutions were approached. Numbers were discussed. ING, the Dutch financial group, agreed to purchase Barings for £1, £1 British pound. A 233-year-old institution that had financed nations and counted royalty as clients was sold for the price of a postage stamp. 2,000 Barings employees around the world reported to work on Monday morning, not knowing if they still had jobs. Many of them discovered they had become ING employees overnight. Some had significant portions of their retirement savings in Barings stock, which was now worthless. They had done nothing wrong, but they paid a price for what one man in Singapore had done. Nick Leeson was extradited to Singapore and charged with fraud and cheating the exchange. He pleaded guilty. In 1995, he was sentenced to 6.5 years in Changi Prison, one of Singapore's most secure facilities. He served 4.5 years. While in prison, he wrote a book called Rogue Trader, describing what he had done and why. It was made into a film in 1999. Ewan McGregor played Leeson. When he was released in 1999, he had been diagnosed with colon cancer in prison and had received treatment. He recovered. He wrote, spoke publicly, and eventually became a business consultant and lecturer on financial risk. He became, in an irony that is hard to process, an expert on the very controls that his actions had made famous through their absence. The regulators who examined the Barings collapse produced reports that were damning about systems and culture, not just individual behaviour. Barings had known that Leeson controlled both the trading and back-office functions in Singapore. This had been flagged internally. The flag was not acted upon. The bank had also been sending large sums of cash to Singapore to meet margin calls on Leeson's growing positions. Nobody asked hard enough why. The profits Leeson was reporting were too good to question. Success bought silence. This is one of the most important lessons the Barings case produced. Institutions do not fail because one person is dishonest. They fail because systems that should prevent dishonesty are not maintained, not prioritized, and not followed when doing so would slow down profits. The fraud was sustained for 3 years by a culture of willful blindness. Every investor, whether they manage a hedge fund or a personal savings account, can take something from the Barings collapse. The lessons are not exotic. They are not theoretical. They are the kind of common sense disciplines that every person handling money should follow. The first lesson is that unchecked positions grow until they cannot be absorbed. Leeson's losses were catchable in 1992. They were catchable in 1993. By 1995, they had grown beyond the capacity of the entire bank to survive. Risk that is not monitored does not stay still. It compounds. The longer it is ignored, the more destructive it becomes. The second lesson is that exceptional returns should trigger scrutiny, not celebration. Leeson was the star of Barings. He was making extraordinary profits. That extraordinary performance was never interrogated. Nobody asked how. Nobody verified the mechanics. They celebrated and extended his authority and sent him more money when he asked. Every investor should be suspicious of returns that exceed what the strategy should realistically produce. The third lesson is about emotional trading. The moment Leeson began using account 88888 to hide his first loss, the outcome of the story was predetermined. He had removed the feedback mechanism. Without the ability to see the loss accurately, he could not make rational decisions about it. He could only escalate. Every investor who has ever averaged down on a losing position without updating their thesis, who has ever held a bad investment past its rational sell point because they did not want to admit being wrong, understands the psychology that destroyed Barings. The bank is gone. Nick Leeson is alive and speaking at conferences. And account 8888 is a case study taught in every business school in the world.